Welcome to the TAC Index AI podcast. We blend tech, IP data, reports, and charts with the latest news and all things logistics, with a real focus on air cargo. Today we're taking a deep dive into, the shifting sands of global trade. Looks like things are transforming quite rapidly.
Yeah, absolutely. We're sifting through some recent reports, Reuters, the Wall Street Journal, and of course connecting it all back to the latest tech index air freight market update. The goal is really to understand the potential impact of these looming U.S. tariffs on Europe and how that could ripple through air cargo, logistics, and, the wider macro market.
Okay, let's unpack this then. What exactly is at stake if these, pretty significant tariffs actually hit, particularly for Europe?
Well, EU ministers are definitely bracing themselves. Reuters is calling it a potential game changer. We're talking about a possible 30% U.S. tariff on European goods, if that happens.
Yeah.
It's seen as virtually prohibiting trade.
Prohibiting trade, wow.
Yeah. I mean, think about it. That's a massive hit to the, $1.7 trillion two-way trading relationship they have?
And digging a bit deeper here, the economic projections are pretty startling, aren't they?
They really are.
Barclays economists, for example, they estimate it could shave, 0.7 percentage points off Eurozone output.
Exactly. Which, for context, basically wipes out the already pretty meager growth they were hoping for.
Oh.
And it's serious enough that it could even push the European Central Bank's deposit rate down, maybe closer to 1% by early 2026. And think about Germany, a huge exporter. They could potentially lose over 200 billion euros by 2028 if these tariffs land in the 20-50% range.
That's staggering. And for our listeners, thinking about air cargo, a hit like that to Germany, to Europe, that has to impact freight demand, right?
Oh, absolutely. A contraction on that scale inevitably means less demand for shipping goods, especially high-value items often moved by air. It could mean shifting trade lanes, maybe less volume on the transatlantic routes. Companies might even start seriously rethinking their supply chains, maybe more nearshoring.
And what seems really interesting or maybe concerning from the reports is it's not just these external threats. Europe seems to have its own internal hurdles, too.
That's a key point. The IMF highlighted this. Europe's own internal barriers, things that act like tariffs between member states, are actually hindering their ability to adapt and diversify.
Like, how significant are we talking?
Well, the IMF estimates these internal barriers are equivalent to something like a 44% tariff on goods and, get this, 110% on services.
110%. Wow.
Yeah. So this internal friction makes it incredibly hard for them to pivot away from that export-led model, leaving them, quite vulnerable to these big external shocks like potential U.S. tariffs.
It's sort of the double whammy then.
Exactly. It forces a real fundamental rethink of their whole economic strategy.
Okay, so while Europe's grappling with all that, let's pivot stateside, because there's tariff talk impacting things there too, especially inflation, right?
Yes, the Wall Street Journal report touches on this. We're seeing consumer prices up 2.7% year on year in June, core inflation at 2.9%. So the question is
that the tariffs starting to bite, or is it more complex?
Well, that's the debate, isn't it? Economists seem a bit split. You do see larger price increases in items often targeted by tariffs, furniture, toys, clothes. That suggests a link.
Okay.
But there are obviously broader inflationary pressures too. Goldman Sachs, for instance, they estimate U.S. consumers might end up footing the bill for about 70% of the direct costs of these tariffs.
Ouch. So higher prices at the checkout counter.
Pretty much. And you hear companies like Walmart already talking about potentially needing to raise prices if major tariffs come in.
And that, of course, feeds back into logistics. Higher prices, potentially less consumer demand. That changes what needs shipping, where, and how much. You'd expect to see that reflected in TAC index data for inbound freight eventually.
Definitely. It's all interconnected.
But then you also have these other signals, like travel demand seems to be softening a bit. Hotel prices down, airline fares dipped slightly in June.
Right, that adds another layer of complexity. Does that signal a more cautious consumer overall? If so, that could also dampen demand for goods, particularly the kind of discretionary, higher value stuff that often flies.
So it really leaves the Federal Reserve in a tricky spot regarding interest rate cuts, doesn't it? Lots of conflicting signals.
Absolutely. It makes their decision-making process very difficult. So if we try and connect all these dots, especially for logistics and air cargo, it's crystal clear that trade policy isn't just some abstract thing. It's directly hitting inflation, economic growth forecasts, even central bank strategies on both sides of the Atlantic.
And those policy shifts, those economic ripples, they translate directly into changes in demand, capacity planning, and ultimately the air freight rates we track on the tech index.
Precisely. It underscores how sensitive our sector is to these geopolitical and macroeconomic shifts.
So wrapping this up then, maybe the key question for you, our listener, to think about is this. How quickly can global supply chains and indeed whole national economies truly adapt, especially to these sudden, potentially quite large shifts in trade policy? And what does that mean for businesses trying to navigate this increasingly complex logistics environment, particularly in air cargo?